This trader thought he had it all figured out, making billions off derivative bets, and living large until the markets humbled him overnight with staggering losses. In this video, we'll uncover 10 shocking occasions when traders and financial institutions lost billions of dollars in a single trading session. At number 10, we have Andy Karger, a legendary currency trader and a loser of $300 million. In 1987, while working at Bankers Trust, he put on a massive short position against the New Zealand dollar that ended up losing his firm $300 million. Karger had developed a reputation on Wall Street as a maverick genius, capable of making huge directional bets with little regard for risk management. When he analyzed New Zealand's markets in 1987, he became convinced the currency was drastically overvalued and vulnerable to a crash. Despite the relatively small size of the country's monetary base, Karger sold short over $1 billion worth of Kiwi dollars, leveraging his position by an astonishing 400-to-1 ratio. For a time, the trade was profitable as the currency depreciated. However, a sudden reversal wrong-footed Karger and the currency surged against his shorts, forcing him to unwind the trade at a $300 million loss. The unhedged bet ended up wiping out almost all of the profits he made for Bankers Trust that year. While the loss was a black mark on his record, it solidified Karger's reputation as a brash, aggressive trader who wasn't afraid to bet big and push the limits. At number 9 is Bruce Kovner, the hedge fund tycoon who reportedly lost $1 to $2 billion for his firm, Caxton Associates, during the Black Monday market crash of 1987. Kovner pioneered the use of global macro investing and was seen as one of the most brilliant traders on Wall Street. In 1987, Kovner built up a substantial long position in S&P 500 futures contracts, betting that the raging bull market would continue charging upwards. However, on October 19th, the stock market cratered, with the Dow plunging an unprecedented 22% in a single day. Kovner suffered staggering losses as his long future positions imploded. With no ability to liquidate the convoluted positions, he could only watch in shock as his funds evaporated. While the exact amount was never confirmed, some estimates put the losses between $1 to $2 billion that day alone, wiping out years' worth of profits. It was a sobering lesson on the risk of over-leveraged bets and the dangers of fighting against market downtrends. However, Kovner's stoic nature helped him absorb the loss and come back determined to rebuild his capital. He stuck to his proven global macro strategy and eventually earned his way back into the billionaire club. The Black Monday massacre taught Kovner the importance of risk management and discipline, lessons that later enabled his firm to thrive for decades. Though the crash left his ego bruised, Kovner's trading instincts were too strong to keep him down for long. At number 8 is Jeffrey Vinnick, the Fidelity Magellan fund manager who lost over $2 billion during the 2008 financial crisis. Vinnick had built a stellar track record beating the market at Magellan, the world's largest mutual fund at the time. However, his heavy bets on financial stocks backfired catastrophically when the subprime mortgage bubble burst in 2008. Believing the sell-off was overdone, Vinnick loaded up Magellan with shares of firms like Citigroup, Bank of America, and Lehman Brothers. As the crisis spiraled into a systematic crash, these stocks plunged, eviscerating Vinnick's fund. It lost over 40% in 2008, amounting to more than $2 billion of Vinnick's capital. The steep losses ultimately forced him to resign from Fidelity in 2009. It was a humbling end to his tenure at Magellan, during which he had previously generated excellent returns. Chastened by the experience, Vinnick started his hedge fund and began rebuilding his reputation as an astute stock picker, proving his acumen could overcome even multi-billion-dollar setbacks. At number 7 is Bill Hwang, who lost a staggering $20 billion in just 2 weeks in 2021. Hwang was the founder of Archegos Capital Management, a family office that used risky leveraged equity swaps to amass huge, hidden stakes in stocks like Viacom CBS. When several of his major holdings dropped, it triggered over $20 billion in margin calls from banks. Hwang was unable to meet the demands, so the banks began unloading his positions, catering the stocks further. In a matter of days, Archegos imploded entirely, inflicting mammoth losses on banks like Credit Suisse while vaporizing Huang's fortune. It was a dramatic demonstration of the immense downside risks that can lurk beneath the surface when using highly leveraged derivative instruments in concentrated positions. The Archegos collapse sent shockwaves across Wall Street and left many questioning the opaque nature of family offices. For Huang, it was a tragic end to his redemption story, coming after a similar blowup forced him out of Tiger management years earlier. And number 6 is hedge fund legend David Tepper, who lost around $2 billion on airline stocks in 2020. Tepper saw value in pandemic-battered airlines and bought shares of American, Delta, Southwest, and United. However, his typical contrarian bet backfired, as an expected travel recovery never materialized in 2020. With air travel still depressed, airline stocks languished, and Tepper faced a rare instance of misreading the markets. By year-end, he sold his airline holdings after losing around $2 billion, a significant blow for his mammoth Appaloosa management fund. While painful, the early unwinding of the trades exemplified Tepper's nimble risk management. The loss marked an uncharacteristic stumble for Tepper, known for his prescient calls to buy distressed banks and debt during previous crises. The airline episode humbled even seasoned veterans like Tepper, showing the folly of trying to precisely time markets amid massive uncertainty like a global pandemic. And number 5 is hedge fund legend Stan Druckenmiller, who lost over $2 billion on tech stocks when the dot-com bubble burst in 2000. Druckenmiller was the top strategist at Quantum Fund under George Soros, compiling an unparalleled 30-year track record of positive returns. However, his streak came to an end after he wrongly bet that tech stocks would keep surging amid the late 90s mania, believing a new tech paradigm was fueling stunning growth. Druckenmiller loaded up on stocks like AOL, Cisco, Qualcomm, and other shining stars of the internet bubble. But by March 2000, it became clear his belief in a new economy was misguided. As inflated valuations collided with reality, the resulting crash vaporized over $2 billion from Druckenmiller's tech holdings, a staggering loss even for one of the world's richest traders. The humbling experience taught Druckenmiller an important lesson in ignoring speculative X's, no matter how enthralling the narrative. The tech wreck was a painful blemish on his otherwise impeccable track record. Having rode the bubble higher, his forced selling compounded the crash. The losses led Druckenmiller to resign from Quantum Fund, ending one of investing's most profitable partnerships. It was an uncharacteristic stumble for one of the discipline's greatest wizards, providing a cautionary tale on the perils of investment hubris, even for those at the very top. And number 4 is John Paulson, the hedge fund manager who lost $3 billion on drug company Valiant in 2016, underscoring the risk of concentrating too heavily on flawed investments. Paulson had shot to fame for massively profiting from betting against subprime mortgages before the 2008 crisis. But in 2016, his major stake in Valiant resulted in billions of losses as the company came under fire for questionable accounting and drug price gouging. Paulson had built up a 5.7% stake in Valiant, believing the troubled company could turn itself around. But as allegations mounted, the stock plummeted, almost wiping out Paulson's entire position down to just $30 million from a peak of over $3 billion. It was a stark reminder that even judicious managers like Paulson can make disastrous mistakes when they become overconfident in low-quality stocks. The huge loss erased most of the gains Paulson had made in the years prior, humbling one of the hedge fund industry's recent stars. While Paulson acknowledged he misjudged Valiant's issues, the concentrated bet contradicted the diversified strategies that had made him successful. It illustrated how hubris can tempt even disciplined investors like Paulson to make foolish exceptions, leading to sudden wealth destruction. The Valiant debacle taught Paulson an expensive and invaluable lesson in the dangers of pride distorting an otherwise cautious approach. And number 3 is Ray Dalio, founder of hedge fund giant Bridgewater Associates, who lost about $3.5 billion shorting Eurozone stocks in 2012. Dalio had built a reputation as an elite global macro investor, adept at anticipating paradigm shifts. He frequently voiced skepticism of the European common currency and expected struggling peripheral economies to drag down the stronger core. Sensing the crisis, Dalio shorted European equities across Germany, France, Italy, and Spain. However, the stocks rallied strongly in 2012 after the new ECB president, Mario Draghi, vowed to defend the euro with unlimited bond purchases. Dalio admitted his doubtful view of the eurozone was proven wrong. His unsuccessful bearish bets lost approximately $3.5 billion for Bridgewater funds. It was a painful misstep for the normally prescient Dalio, who prided himself in macroeconomic insight. Dalio learned even the best analysis can misread political events like central bank interventions. The loss marked a humbling lesson that markets reflect human decisions, not just numeric data. While the Eurozone remained fragile, Dalio's mistimed short illustrated the folly of fighting overwhelming police power. The Eurosceptic bets ran counter to Bridgewater's balanced portfolio approach, reflecting Dalio's own cognitive bias. The loss served as a reminder, even legendary investors like Dalio remain fallible despite towering reputations. And number 2 is famed value investor Jeremy Grantham, who reportedly lost $3 to $4 billion on Black Monday in 1987, the largest single-day market crash ever. As co-founder of asset management firm GMO, Grantham built his reputation spotting underpriced stocks, but also by marking timing based on broader cycles. Sensing overvaluation in 1987, he moved heavily into foreign stocks after selling most US holdings. However, the global scope of the Black Monday sell-off shocked Grantham, as did its unprecedented severity, with stocks plunging over 20% in a single day. Even defensive positions like high-quality foreign equities cratered. When the chaotic day ended, Grantham had lost an estimated $3 to $4 billion, as some of his largest funds were eviscerated. It was a painful lesson on the ferocity of panic and the importance of risk management. In the aftermath, Grantham called it the worst day of his investing life, humbled by how quickly markets can move against even the most judicious positioning. While Grantham's value discipline later rebounded, Black Monday taught him that exiting bubbles requires exquisite timing before panic reaches its apex. Though the crash left Grantham's funds deeply wounded, it imparted lasting wisdom on guarding against events that seem unthinkable till they suddenly occur. Finally, at number 1 is Bill Ackman, whose ill-fated investment in drug company Valiant cost his Pershing Square hedge fund a staggering $4 billion loss. Ackman had bought a major stake in Valiant, believing its charismatic CEO could lead a turnaround. But as accusations of fraud and price gouging mounted, Ackman stubbornly defended his position even as the stock plunged. He finally admitted defeat in early 2017 after a devastating $4 billion write-down, a blow from which Pershing Square has yet to fully recover. The enormous loss was a hard lesson in the risks of concentrating capital in deteriorating companies based on faith and management. As Valiant's business unraveled, Ackman's refusal to cut bait cemented one of the worst missteps ever for a hedge fund manager. The Valiant debacle taught Ackman an expensive lesson in flawed due diligence, as his uncharacteristic deference to management overruled his typical analytical rigor. For an activist known for targeting companies, Ackman ironically became entrapped in one of his investments. The multi-year saga inflicted grave damage to Pershing Square's track record and Ackman's reputation as a shrewd manager. Though humbled, Ackman ultimately survived the reputational blow, continuing his active investment career despite the Valiant flop marring his resume. Let us know in the comments below which of these losses shocked you the most, and if you know any other examples of traders who lost billions in a day. And definitely check back for more videos like this. We'll see you in the next one. Have a good one, and happy trading.